to me, your financial future isn't necessarily shaped by your income. It's really shaped by decisions that you make. I find that there are people that are super high earners that don't have any money in the bank. And then you have people that don't make a lot of money, but they've got saving.
Welcome back to Penny and Trending. I'm Dedra Quinn. Today's guest is Brendan Lewis. He's Vice President and State Manager with Asset Preservation Incorporated. He helps investors across the country use 1031 exchanges to build long-term wealth through smart tax strategies. We'll discuss how successful investors think beyond a single transaction, avoid costly mistakes, and keep their capital working for them. Let's get started. So, how do wealthy real estate investors use tax strategy rather than investment strategy to actively build their generational wealth?
So, I think that's a great question. I think that, the one of the main things is having a long-term approach to your strategy. I find that a lot of investors, they approach things on a per deal kind of basis. Did I do well with this deal? Did I not? Rather than looking at kind of a longer term approach. And does this exit fit into my long-term strategy? So I think that's part of it, for sure.
Now, I know you do a lot of educating as well on the strategy. So, how does understanding the strategy change how an investor might approach a real estate transaction and use a 1031 exchange?
So I do a lot of education. I educate, obviously I'm on the phone with exchangers all day long, but also advise, their advisors as well, educating those folks. I think that the key is understanding the timelines, understanding the rules, what qualifies, what doesn't qualify, and being able to kind of leverage that to be able to make more informed decisions about, your real estate investing strategy, keeping your equity working for you rather than writing a check to the IRS for a large portion of the gain in the property that you're just, disposing of. That kind of is a big part of it.
So, can you talk to us about keeping capital in motion and talk about that a little bit and how that 1031 exchange can accelerate your long-term portfolio?
If implemented correctly, really you're looking at a way to keep your money working for you, right? As I kind of just touched on earlier, if the taxpayer has a significant gain in their investment or business use asset, they will oftentimes they're faced with the decision of, do I write a check, pay the taxes, move on? Or if they are going to reinvest into another asset, being able to take advantage of a 1031. So that's first and foremost, being able to just continue that, keep that capital working for you. Another way to look at it as well is the investor in a stage in their life where they want to take on a little bit more risk, right? They may want to buy a more expensive property. Maybe they're selling something where they've got $1 million of equity. Maybe it's all equity, right? $1 million sale. And they want to go leverage up and buy something for $4 million, right? Put 25% down and being able to kind of lever up. So that's another strategy. I think that oftentimes the average investor kind of looks at, it's like, right, the expression death and taxes. It's like taxes are a foregone conclusion. You just have to deal with it, right? But when it comes to investment or business use property, it really does make sense to at least consider doing an exchange. A lot of it has to do with, again, what is your long-term strategy? What are your goals? You don't want to do an exchange just for the sake of not paying taxes. It's not a bad idea, but really it should be part of a greater plan and a greater strategy long-term.
One of the questions that I get a lot revolves around like properties. So I know sometimes investors want to kind of change the course. And so can you educate our listeners a little bit on that?
Of what's considered like kind?
Yeah, like kind.
Yeah, the definition is, and that's another term for these exchanges, right? They call them 1031 exchanges because it comes from Section 1031. Like kind exchanges, tax-deferred exchanges, it's all the same thing. But a like kind exchange really it's not as specific as you would think. You don't have to sell a single family rental home and buy another single family rental home, right? Really, if it fits for use in a business, for use in a trade, for investment, it pretty much qualifies, right? You cannot buy a principal residence out of it. There are rules when it comes to vacation properties. So they can qualify, but the IRS is pretty strict about those rules. The like kind is very broad, right? I have clients who will sell a business asset, and maybe they're retiring, maybe they sold the business, but the real estate portion, they still own it. So they want to divest themselves of that. And then they're going to go buy an investment property that's going to generate sort of longer term income for them in the future. So, I had not that long ago, I did an exchange for a client who owned he was a mechanic, right? And so he had a shop, sold the business. His tenant became the buyer of his business. The purchaser of his business became his tenant. Well, a few years down the road, he decided, I don't want to own the building anymore. So he sold it and he bought a multi-unit, just a few unit apartment building. That's an example of how that like kind rule is actually pretty generous. Is it considered real property? Is it for use in a business trade or for investment? It pretty much qualifies.
Great. Thanks for clarifying that. So, what is one of the biggest mistakes that real estate investors make that can cost them thousands of dollars over a lifetime?
I think that, too many investors, as I kind of touched on earlier, too many investors look at the short term versus long term. Is this a good deal? But really they should be looking at it as, how does this fit into my longer term strategy? I think that, another thing that's important is kind of planning, right? How do we plan, looking at before the transaction occurs, during the transaction, and then post transaction, right? So before, I often find the biggest mistakes investors make is they don't really define their goals and objectives before going into a decision about a transaction, whether they're buying or selling, or they wait too long to get their advisors involved. That is probably, I would say, the number one mistake, right? Just because if you think about it, we can go through all the different types of advisors and why they're important and all of that. But if you think about it, I mean, these are the people that they know decisions shouldn't be made in a silo, right? And having that team of people that you've brought together, whether it's your, attorney, financial advisor, your real estate agent, broker, your CPA, all of those people, they all have their specialty. And so having individual conversations with them, it may be fine, but you also want to loop them into a greater conversation about whatever the transaction entails, whether you're buying or selling, it doesn't matter. But that's one of the biggest things. I would say kind of during a transaction or in the midst of it, you do have your back against the wall in a lot of ways when it comes to the timelines associated with the 1031. So you're looking at 45 days from the date of close to identify replacement property, and then a total of 180 days to close on that replacement asset. So if you're looking at sort of during the exchange window, I often find that people make decisions under pressure, and it turns that strategic decision into a reactive decision, right? We can't find what we want, so we're just going to park the money somewhere. And that could be fine if you have no other choice, but that shouldn't be your only option. And you should know what options are available to you in terms of replacing assets. Do I want to be, some investors are looking to go passive. We can talk about trends probably a little bit later, but a lot of investors are heading in that direction. So being able to know what qualifies beyond just like kind, what other types of ownership structures qualify under a 1031, that's important going into it, because it does give you options in the event that something doesn't work out. The mistakes that a lot of investors make in terms of after the transaction's already closed is they move on to the next deal without asking themselves if they are working toward their long-term goals, right? And every transaction should position you for the next one. Kind of an example is I talked to a gentleman on the phone a couple of weeks ago, and he was probably in his late 50s, and he owns a lot of real estate, but it's just, number one, geographically, it's all over the place. which makes it very difficult to manage. And then two, it's a lot of different types of assets. So he's got single family homes, he's got self-storage, he's got all this different stuff. And he was under the impression that he was making good financial decisions in having all of these different types of assets to kind of hedge against various things that could happen. But instead, he's running too many businesses at once, and so it's like wearing too many hats, and so that can be another kind of detriment to an investor's financial success.
You mentioned also something in there about perhaps not spreading yourself out and running so many businesses. And then I also, I hear people talk about diversifying, which perhaps is kind of where your client's mind was going. So can you dig into that and unpack that a little bit more as far as location and perhaps current market cycles and perhaps, not diversifying to the point that you're running so many different businesses?
Well, I think that, real estate is real estate. And that's kind of I think that's what's in people's mind, is that concept, is that, does the deal cash flow? Does it, all these different kinds of kind of indicators of if it's a good investment. But you also have to think about, these are all different types of businesses, right? So if you own a retail space and you own a self-storage facility and you own single family rent homes and I'm just describing this guy's, he was involved with marinas too, where he owned like a percentage ownership in a marina. These are all different types of businesses. It would be like, it's fine if I'm going to be be the QI, but I'm also not going to be, I'm not interested in being the real estate agent in the transaction and somebody's CPA and somebody's this. It's too many hats to wear. And while they may all somewhat be related to the same topic, but these people have their individual specialties, right? Just the same as understanding the world of self-storage. That's something unto itself, from multifamily, from single family, from retail, from office, from industrial, all of those different kinds. And so I think that there's different ways to diversify without trying to collect as much real estate as you can. It's having a big portfolio is not always the best strategy, right? Because to me, it's about being more intentional and about being more kind of mindful about where do you want to be in 5, 10, 20 years, depending on how old the investor is and what their goals are. So I think it's about being intentional.
If somebody wants to build long-term wealth through real estate, what is the core principle that matters more than the current market cycle? And what recommendations would you make?
Probably about 4 or 5. I think first, I've said it multiple times, but I think, thinking long-term, think 10, 20, 30 years down the road, that's really important. It's all dependent on how old the investor is when they're getting into this kind of world, but protecting your capital would be probably the second. Keep as much of your money working for you as possible. A great way to do that is obviously a tax-deferred exchange. I think buying with discipline rather than emotion. I find that a lot of people will sometimes, again, it kind of goes back to, I want to build a big portfolio rather than building an intentional portfolio. Another one would be surrounding yourself with a good team. And then I think lastly, I find that sometimes investors want to, it's sort of the opposite to being diversified, like the gentleman I described earlier. You want to stay adaptable. I think that's important. I've seen people over the years who have really doubled down on certain, asset classes or certain product types that maybe aren't doing as well as they once were. And that's kind of all they know. And so they stick with it. It's not always the best decision to make just because it's what you know. Maybe it's a better idea to kind of be adaptable and move into a little slightly different space. I think that, the perfect example, just to give a quick one, is I know a lot of folks that build up these single family portfolios where they'll own 5 or 10 or even 20 single family homes, right? The management that's all they know, right? They've only ever owned single family homes and they understand that model. They get it. That's great. But as they start building a larger and larger portfolio, oftentimes what happens is that the management just becomes untenable, right? They've got tenants coming in, moving in and out. because just sheer volume of the properties that they own. So maybe it makes sense for them to sell off some of those single family homes and go into a multifamily asset where they can have professional management on, with one site versus multiple sites, things like that. So just because it's what you've always done doesn't necessarily mean it's the best thing to continue doing, I guess. That would be kind of my last one.
Is there a single thing that you would share with our listeners that could change their business, their life in terms of financial freedom?
To me, your financial future isn't necessarily shaped by your income. It's really shaped by decisions that you make. I find that there are people that are super high earners that don't have any money in the bank. And then you have people that don't make a lot of money, but they've got savings, right? And so I think it's kind of about maybe thinking like a CEO when you look at your real estate investing portfolio and building that portfolio. It's like how maybe a CEO would look at scaling a business. You don't have to know everything. You've got advisors who can help you with the things you don't know, but it's about having a kind of seeing everything from an altitude and being able to make informed decisions in that sense, rather than kind of getting into the minutia of things or trying to micromanage every aspect of it. I think that's kind of the smartest investors that I've seen tend to kind of operate that way. They have more of a, yes, they're hands-on, they're very involved, but they've got a great team of people and they trust their team and they really operate more like a CEO would operate.
How can our listeners find you?
They can find me a couple different places. Our company is Asset Preservation Inc. We're a qualified intermediary in all 50 states we operate. I happen to be located in Texas. I handle transactions all over the country. Email me, Brendan, BRENDAN at APIexchange.com, or they can call my direct dial toll-free number 833-756-1031. And then one of the things I'll just mention is that it's never too early to engage us in those conversations. We don't charge to have have a call with folks to advise them on the structures and kind of the tips and tricks. It's never too early, but it can always be too late. So if you're even contemplating the sale of an investment or business use property, it's worth having a conversation to see what your options are.
Brendan, thank you so much for joining us today and sharing your expertise. If there's one takeaway from today's conversation, it's this. Successful investing isn't just about buying and selling real estate. It's about having long-term strategy and the right team in place. Thanks for listening to Pending and Trending. I'm Dedra Quinn. Until next time. If this episode was helpful, check out the next episodes of Pending and Trending for more real conversations around building wealth and financial freedom.